Yeah, so you guys will be officially in front of me. This will be, because they're still in chapter, they just finished chapter 3 today. So they'll start in chapter 4 Thursday. So if you guys want to see this again, you could go watch. I guess you could watch their videos at home. Get this. But if you want extra credit for it, you can come into another class and watch it. So you can come into their class and watch it. That makes sense? You see something you want to read. All right. So we're doing chapter 4, which is accounting for merchandising operations. So right now, okay, so at the end of chapter 3, we changed up how we did the balance sheet. And it told you that the balance sheet will be classified, and we're going to organize it and liquidity, right? Current assets go first, long-term assets go second, right? Current liabilities go first, long-term liabilities go second. Now in this chapter, what we're going to do, we're going to change up the income statement. Up to this point, the income statement has been what we call single step. Write that down. And basically, you have the revenues on top, expenses on bottom. Revenues minus expenses gives you net income. Now we're going to change this, because this income statement here is good for the service organizations, right? Service industry. Plumbers, law firms, accounting firms, those types of organizations. But now we want to deal with merchandisers and manufacturers. Manufacturers are organizations that create. Merchandisers are like middlemen. They're between, here, they're between the manufacturer and the customer. To give you an example, let's say Tide. Tide is created by Procter & Gamble. Have any of you gone to Procter & Gamble and purchased a box of Tide? No. Okay. You've gone to maybe Walmart or Target and bought Tide. You haven't been to Procter & Gamble. Why? Because Procter & Gamble, they sell Tide in bulk, basically by the pallet. And I don't know about your house, but in my house, I mean, my kids are pretty dirty, but they don't need a pallet of Tide to get us through the week, right? We only need one box. So what happens is your local, let's say Walmart, will buy the Tide in bulk from Procter & Gamble, and then they'll break it down into smaller bite sizes, which you and I, the consumer, can take. Everyone with me? So basically, Walmart is the middleman between the person who sells it or creates between the company that creates the product and the company and the customer. Now, with that being said, we're going to extend out this financial statement. I'm going to skip a couple of slides up because I want to show you I'll show you what that income statement is going to look like. So the income statement is going to start with sales. And the first thing we're going to minus off is sales discounts and returns and allowances. Sales discounts, you pretty much probably know what those are. They're just discounts that the company or the merchandiser offers the customer for buying product, right? 5% off, 10% off, what have you. Sales returns is probably something you also pretty much know about, right? It's just a customer gets product, it doesn't fit their specifications, so they bring the product back for a refund. That's a sales return. And the last part of this equation is sales allowances. Now, sales allowances, let me ask you, how many of you know what a sales allowance is? Oh, So a sales allowance, oh, did the lights go off or something?
I think the air went off too.
Okay, we're gonna have to wing it. So a sales allowance, does anybody know what a sales allowance is? All right, a sales allowance is when a company, so the manufacturer or the merchandiser provides a product, and then the buyer says, the product doesn't really fit my specifications. And the merchandiser says, well, if you keep the product, instead of us selling it to you for $3 a box, how about we sell it to you for $2.50 and we'll give you a 50-cent discount? And they say, fine. That's called a sales allowance. Everybody with me? It's just like a discount, but it's just that technicality in there. That makes sense? They give them a discount because they kept product. Everyone with me? So that's your sales allowance, right? After your sales allowance, sales minus sales discount minus sales allowance, returns and allowance. We review net sales. And then after that, we're going to subtract cost of goods sold. Most popularly COGS, cost of goods sold. You're going to get gross profit. After gross profit, we're going to have operating expenses. And general administrative expenses. Get your total expenses. After total expenses, we're going to have extraordinary income, extraordinary income or one-time income events. Maybe you, I'm sorry, I didn't say extraordinary gain. These are one-time income events. Maybe you you sell a building, right, for a gain. That's extraordinary gain. There's also extraordinary loss. And those are one-time loss events. Maybe you have a building that was caught in the recent floods in North Carolina, and that's just a one-time loss. Everyone with me? So extraordinary gain or extraordinary loss will get you to earnings before interest, taxes, depreciation, amortization. this part here, from here to here, I'm adding that on because that's normally what's on the income statement. See if we can get it back up. No.
What's the, what does the A stand for?
A. Oh, amortization.
What is that?
Great question. When we discuss depreciation in the upcoming chapters, when we discuss depreciation in upcoming chapters, well, let me get this all here for a second. Depreciation is when we measure the usage of an asset, a long-term asset, but a physical asset, right? When we amortize something, those are intangible assets. You with me? So it's like we're going to depreciate like copyrights. That make sense? No, maybe because we're not in chapter. That's chapter 7 or 8. But we'll have all these assets that we'll depreciate. They'll be tangible. Some will be intangible. There'll be natural resources also. And there's different words that we use to identify how the method or what it is. That makes sense? So depreciation is for a tangible asset. Amortization is what we do to intangible assets. So there are assets on the books that are intangible. What's another good one? A leasehold, trademarks. Oh, trademarks, right? Like a brand, right? So if I do this, what does it stand for? It's not good. McDonald's, right? And that's a brand, right? And that brand has a trademark, and that trademark has a valuation to it. That makes sense? Because you don't want everybody just to start using your sign. Then you go down here to, local pollo, and they'll be like, oh, let's put the McDonald's sign out front so people can start coming through. Right? But we're selling chicken. That's not how it works. That makes sense? There's no local pollo. Anyway. So that brand has a valuation to it. And that valuation is on the books, but the brand is intangible. So we amortize that brand. Are you with me? Yes. Without going too deep into it. All right. So I'm going to show you let's go over some purchases of merchandise. So on June 20th, Jason Inc. purchases $14,000 of merchandise inventory, right? Paying cash, right? So this transaction is cash or credit? Cash, right? So Jason Inc., they use the cash to buy inventory. So is cash increasing or decreasing in the company? Decreasing. How do we reflect the decrease in an asset? Did I say cash was an asset? Yeah. How do we reflect the decrease in an asset? Credit. Now, what do we use the cash for? Merchandise inventory. Merchandise inventory is what type of account? Asset. Then we increase or decrease our merchandise.
Increase.
How do we reflect an increase in merchandise in an asset? Yeah. Good. So So we're gonna debit merchandise inventory and we're gonna credit cash. That's just a regular purchase of inventory. Everyone with me? Put in merchandise inventory, that reflects these are assets that will be sold in the future. Now, trade discounts. This is how it works. Let's say Matrix Inc. offers a 30% trade discount for orders of 1,000 units or more, right? The erasers are $5.25 a piece. So the company decides they want to take advantage of the discount. So we'll purchase 1,000. So we'll take 1,000 times the $5.25, you get $5,250. The discount is 30%, so 30% of $5,250 is $1,575. Let me stop here and say this, scholars. This is a common mistake I see. People will say, oh, it's 30%, so I'll take 5,250 and times that by 30. And they'll come out with this as the discount. What's wrong with that? It's 0.3, right? It's 0.3. Everyone with me? So then 1, 2, move this decimal over. It's 1,575. Go ahead.
So that's a common mistake?
It's a common mistake. Be shocked. I don't think it's one of those common mistakes where students don't know, but when you're in the minutia of just doing the accounting work, you just say, oh, okay, just times it by 30.
Right.
That makes sense? And they don't think the 0.3 through. It takes a second. You know, I don't think like students need to go back to 7th grade or 6th grade and figure out decimals. That's not what I'm saying. I just say it's a mistake to do. Right? When you're already stressed enough over journals and depreciation and we'll do bad debt expense and aging and all that type of stuff, reconciliations, you're so stressed on that, little stuff like this, it'll just take you. All right. Invoices. Let me take a second here and say this. When you have your fantastic multi-million-dollar job, let me give you fair warning ahead of time. Make sure you don't pay until you get invoiced. Right? Transactions are a legal thing. They're legal. That makes sense? And the transaction is not complete until you do the invoice. There are a lot of people nowadays, they go ahead and pay because they already know how much they owe. You really don't pay until you get an invoice. And there are a lot of things on this invoice that you need to know. Okay? So you need to know the invoice date. You check to make sure the product is there at the right price. And then the terms. So the terms are critical. Because the terms tell you when you're going to get your discount. How you say this term is this 2 of 10, net 30. 2 of 10, net 30. Let me write this down. This is something I saw a new hire 2 years ago get fired about. So I harp on this a little bit. 2 of 10, net 30. There's a language of business. If any of you guys ever watched Bloomberg and thought, what the hell are they talking about? Like, you know the words that are coming out of their mouth is English, but you don't understand what they're saying. That's because they're speaking the language of business. You've got to get well addressed in it. One of the reasons why I have the workbook is to help you get well addressed in it. Okay. So this is 2 of 10, net 30. What does it say? It says that there's a timeline. That timeline states that from the invoice date, it is due in 30 days. From the invoice date. However, 2 of 10 means if you pay in the first 10 days, you will get a 2% discount. So if you pay in the first 10 days, they'll give you a 2% discount. From the 11th day to the 30th day, you owe the full amount. Everyone with me? Story of warning. Student from UVA worked for one of the companies that I advise. I would say I advised them. They had a fantastic, this job gives a fantastic benefit. Right out of college, the student was making about 60, 70,000 plus housing. Right? Very good job. A lot of young professionals there, fantastic place to work. They were there to do receivables, accounts receivable. They were in accounting. One day in a meeting, the CEO was talking about how he's trying to restructure the contracts to get the clients off net 60s, which gave them 60 days of pay, and get them on net 30s. And all the CEO did was speak the language of business. I want to get these clients on the net 30s. That new accountant was allowed the opportunity to sit in on that meeting with the CFO, the CEO, and many of the higher ups of the company. During that meeting, that student, that new employee, had the courage, although misplaced, to raise their hand and interrupt the CEO because they had a question. Let me hit pause. You've got to pick your timing. You are not the most important person in the room until you are bringing in the most revenue in the room. Till that point, you need to let people talk. That makes sense? Many of you have had your ideas taken immediately. It's not how corporate America works. You give us your idea and we'll think about it. Just like you thought about it, that's how you came up with the idea. Everybody with me so far? Individual raised their hand. CEO looks around in this amazement. I looked around, everybody kind of looked, kind of like, wow, this kid raising his hand. I said, yeah, what do you want? He said, sir, what's a net 30? He didn't even know what a net 30 is. It's in chapter 4 of Accounting 211, Intro to Financial Accounting. This kid had an accounting degree and didn't know what a net 30 was. The kid walked out, he walked ahead of us. The CEO looked at me and the CFO, and our quote said, get him the fuck out of here. That was the Tuesday. He had just got hired that Monday. I looked at the CFO and I said, do your job. The kid was fired by Friday. Business does not sit around and have these crazy conversations with you about what you think and what we think, and we're right and you're wrong. You know, like you ever been in your science class and someone says, well, I don't believe in God. The science teacher said, well, no, I guess it would be the other way. They say, I believe in God. And the science teacher said, well, that's not how it works. And then there's that back and forth between the two entities about what is right and what is wrong and how that works, blah, blah, blah. That works when you're broke. When you don't make much money, you don't make many decisions, and you're on the bottom of the totem pole, you can argue about stuff like, is the coffee hot or should we have decaf? You can argue about, do the Washington Redskins make the right choice of getting Alex Smith and getting rid of Kirk Cousins? You can make those types of crazy conversations. But at the top, there are certain straight laws. This is the way it is. We're not having a conversation about it. That's it. And there's a certain understanding that you should come to the table with a certain amount of information. We don't teach you certain things. You either know it or you don't. And this is to give people who think they're going to take a shortcut through business school a little time to think about pumping their brakes. Because you're in an area where most of the greatest business schools in America are. You're basically, I would like to say this, you're basically in the SEC of business schools. You go and play football somewhere else. But in this area, you got some of the top business schools in the smallest concentration. Because by the time you could leave here and go down to UVA, you could have left here and went to Philadelphia and gone to Penn. That's two of your top 5 business schools right there. Some people say, well, you know, I'm gonna just go to VCU. VCU is an up-and-coming business school. William and Mary's top 25. James Madison is number 40. Virginia Tech is actually number like 40. So people don't even realize the 3 top business schools in Virginia, the 3 schools that are in the top 25, no, it's 4 schools in the top 25. It's Virginia, it's William and Mary, it's Richmond, University of Richmond, and it's Washington Elite that people sleep on. They're just turning out fantastic talent. They're above James Madison and Tech right now. And James Madison and Tech are turning out fantastic talent. I haven't got around to talk to you about Georgetown and Johns Hopkins and other Maryland, top 11. These are great business schools, all in one little area. People at Mason sometimes criticize me because I say, well, Mason doesn't have a top. You know, I don't count them in the top 10 of business schools. They have almost a problem. But I'm like, look, you are a giant amongst giants. If you took George Mason and you put them in, let's say, North Carolina, they probably have a top 3 or 4 business schools, maybe 5th. I mean, you definitely say Duke and North Carolina would be ahead of them, and then they probably, you know, then they will be in that Wake, UNC Charlotte conversation. They would be there. They're just in the wrong area. That makes sense? Let me give you an example. It's like, ooh, here we go. The lights again. It's like being born in the Miller household, right? In the Miller household, the son said, he gave the story one time, he said he scored 50 or 60 points in high school, and he was like one of the top scoring, like he scored more points than anyone in high school. He was in the top 3 or 4 that night of scoring of all time in California high school, right? He said he went home or he went home and got in the car, and he said, man, I'm like number 4. He said, but the crazy thing is, somebody was number 1. Somebody, like, there's another. So, long story short, he would have been number 3, but somebody that night had outscored the number 1 person, so he ended up being number 4. Guess who ended up outscoring the number 1 person? His sister. His sister dropped 102 points that night. And so, if you don't know, his sister's name is Cheryl Miller, and his name is Reggie Miller, and they're both in the Hall of Fame. So you might just be the second best basketball player, but it just might so happen that your sister is the greatest female basketball player to ever play. That makes sense? Same thing with Mason. You might be second or third best, but you're in the SEC of basic schools. So to trickle it back down to you guys, you've got to come here and you've got to be ready to work, because there's no sleeping business school here. None of them. None of them are just, oh, you just go there. They're all top-notch schools, because their competition, they're competing for the top talent, and their competition is the top business schools in America, if not the world. Everyone with me? So, you can't get a degree and then come out and say something foolish like, what's net 30? That doesn't work. Doesn't cut the mustard. Nobody's paying you $60,000, $70,000 a year, plus benefits, housing. This person had his own apartment for free. Housing. Don't pay you that just for you to come in and show them that you don't know. Everybody with me? And business is very, as I said, it's very low conversation. No business leader is going to be sitting around. You say, well, I feel like net 30 should really be net 45. Yeah, okay, you will see yourself to the door. It's net 30 and net 45 are two different things. You don't come in, you don't pontificate. You come in and bring value, but you don't come in and just start pontificating. That makes sense? Like, you're in English class, there are a lot of other studies that you can do this type of stuff. You can come in and take liberties and feel like, well, I feel like this. You can't do that in business. They're making millions of dollars for a reason, and billions of dollars for a reason. Not because they suck and they need your help to come in and fix it. There's a difference from coming in and fixing something and coming in and adding value to it. That makes sense? When you come in and fix something, my tire got a flat. I took it down to Costco, they fixed it. That makes sense? It wasn't working. I can't drive it with a flat. Adding value means that all my tires are fine, but you say, you know what, some 20-inch rims would look great on that. And now I got 20-inch rims. That's adding value. That make sense? All right. So make sure you know certain things. And there are things I will tell you as we go along. I'll say, you need to know this. This thing go on again? Oh no, it's coming slowly. Jeez, that's creepy. Guess it got warm up or something. Y'all see that? Yeah. It's like the bulb got warm up. All right, so let's do a transaction. So Jason Inc. purchased $27,000 of merchandise inventory on account credit, 2 of 10, net 30. Cash or credit? Credit. Credit is what type of account? It is a liability. What are we gonna call it, liability?
Accounts payable.
Yeah, accounts payable, that'll work. Then we increase or decrease the credit in the company.
Increase.
Increase, how do we reflect an increase in a liability?
Credit.
Credit, fantastic. What do we purchase with the credit?
Merchandise.
Merchandise inventory, right? Merchandise inventory is what type of account? Asset. Then we increase or decrease the assets in the company.
Increase.
How do we reflect an increase in an asset?
Debit.
Yeah. Fantastic. So we're gonna debit the account 27,000. We're gonna credit our accounts payable 27,000. Everyone with me so far? Go ahead.
So if they pay in the first 10 days, how would you have?
I'm about to do it in a second. All right, now Jason ain't paid by May 7th, so they're within the discount period. So what we're going to do is it's 2 for 10, so they're gonna get a 2% discount. So we're gonna take the 2% times it by the $27,000 bill, and that's a $540 discount. Are you with me so far? So we paid off our bill, so we're gonna debit the accounts payable, because we don't owe the credit. We sent them $460 check, so we're gonna credit the cash. And then for the $540 discount, we're gonna credit the merchandise inventory. Scholars, why did we credit the merchandise inventory instead of credit an account, like a discount?
Cost principle?
Good. Wow, you really went deep on that. You said the cost principle. It is the cost principle. Because the truth is, we did not pay $27,000 for the merchandise. We paid $26,460. So when we did that credit for $540, if you see here, we brought the merchandise inventory account to $26,460, not $27,000. Does everyone understand that? So we're adjusting that account to how much we actually paid for it. We need to know how much we actually paid for the product, because that's how we're going to figure out cost. We need the cost of product to figure out how much we're going to do what? You need to know how much it costs you to figure out how much you're going to do. Yes, how you're going to figure out your profit, but there's something just before profit. Hmm?
Sales tax.
No. Okay, revenue, I'll take revenue. You need the cost to figure out how much you're gonna set the price at. That makes sense? Like for these goods, it's $26,460 worth of goods. So you need to set it at least at $26,461 to make some type of profit. That makes sense? Eventually you'll know that's what I'm talking about is the gross profit, not our net income. But right now, you need to know the cost in order to set the price. I'm going to do the discount. We've already talked about this, returns and allowances, right? Remember, purchase returns refer to the buyer acquires what they return the product back to the seller. And the allowance is when they purchase something but it's defective for the buyer, so the seller gives them a discount. But I want to go over the journal transactions on how that works. So if Matrix Inc. purchased $20,000 of merchandise inventory on account, credit terms are 2 of 10, net 30. If they do that, then we're going to debit merchandise inventory, credit accounts payable. Everyone with me? Let's say on May 10th, they return $500 of defective merchandise. What's going to be our journal transaction? Debit what, credit what? Let me go back to prior. This is your first transaction. Debit merchandise inventory, $20,000. credit accounts payable for $20,000. Now we want to return $500 worth of that merchandise. What will be our journal transaction?
Credit merchandise inventory.
Credit merchandise inventory, 500. Debit what?
Accounts payable.
Debit the accounts payable, 500. There we go. Everyone with me? The opposite transaction of the last one, just for the merchandise that you're returning. Now, let's say on May 18th, Matrix Inc. pays. All right, what was owed on May 9th? When they pay, the first thing you need to do when you're going to get a discount and you've returned something or you had an allowance to it, the first thing you do is subtract that return or allowance. So we purchased the customer purchased $20,000 worth of material. No, we purchased $20,000 worth of material. We returned $500. So now we have $19,500 worth of material to apply the discount to. The discount is 2%. So 2% of $19,500 is $390. So we subtract the discount, we get $19,110. So we will debit accounts payable $19,500. We'll credit the cash $19,110. That's how much we paid for the product. And we're going to credit our merchandise inventory $390 for our discount. Questions on that transaction?
So the discount is not gonna charge from the actual amount that is 20,000, it's gonna be the remaining.
The remainder. Yes. Please make sure when you're doing this calculation, scholars, you take out the returns and allowance first. Then you apply the discount. Do not apply the discount before you do the returns and allowance. Everyone with me? All right. Next, we're going to talk about transportation costs. This might be where I'm going to stop, but transportation costs, this is going to be the first place where we discuss words changing a calculation. This is where words are changing calculation. Initially, we did cash and accrual basis of accounting. That will change your net income. If one person does cash based, one person does accrual, that could potentially change your net income. Another thing that can change how you calculate is FOB shipping point and FOB destination point. FOB stands for free on board. That's how your book will say free on board. I am old. So this is an old term. We always had FOB. But for us, it used to be freight on board. If you say freight on board now, they'll be like, oh, your teacher was old. Free on board. They'll say, oh, yeah. Now, how do we distinguish this? If you're using FOB shipping point, the ownership of the product is not transferred to the buyer until the product leaves the dock of the seller. So the minute the seller puts it onto the transportation vehicle, it is now the buyer's. Who pays the transportation costs? The buyer. That is your major concern as an accountant. FOB destination point. The product is not the buyer's until it is in their hand and they sign for it. Until then, it's the seller's. Who pays for the shipping? the seller. Please keep that in mind, because an example will look like this. And I'll go back to this slide. I want to just make sure I'm fluid in what I'm saying. On May 12th, Jason Inc. purchased $8,000 of merchandise inventory in cash and also paid $100 transportation costs because it was FOB shipping point. FOB shipping point, Jason is the buyer, so Jason has to put the shipping costs on his books. If it was FOB destination point, then he didn't have to make that he wouldn't have to record it. Everyone with me? It's FOB shipping point, so Jason needs to make that transaction. What that transaction is going to look like is $8,100 for inventory, debit, credit $8,100 for cash. Now, some of you might be saying, why isn't it, Professor, just an $8,000 debit for merchandise inventory and a $100 debit for, let's say, shipping costs, transportation expense? Because merchandise inventory, we're going to talk a lot more about this in chapter 5, but in chapter 4, I'm introducing you to it. Merchandise inventory includes everything that it costs to bring product up for sale. Everything that it costs to bring the product up for sale. So it's not just purchasing product, it's also shipping it, insuring it, storing it, and everything else. Everybody with me? So this number, the merchandise inventory, is not just buying product. It's everything that it takes to bring product up for sale. And I think this is where I'm going to stop with you guys today.